This is another accounting problem dealing with the kind of business that you're likely to have to deal with. Corporations are very, very common. They're probably the most common form of business entity. You will probably never be asked to prepare financial statements. That's what they hire fools like me for. But you will be asked to read, interpret, and understand. So let's dig into this. This is talking about issuing common stock. And let me walk you through some of the accounting babble. They have 50,000 shares of $10 par common stock authorized. What that means is that when they organized their corporation, whatever state they organized it in, said, okay, Iron Co. or S&J Iron, you can sell up to 50,000 shares of stock at a par value of $10. That's told them by the state, wherever they incorporated. In March, they issued 6,000 shares of the stock for $16 per share. Issued is accounting babble for sold. Okay? So they sold 6,000 shares of stock on March 1st. On May 2nd, the company sold an additional 10,000 shares of stock for $18 per share. Now, an accounting rule, and it's just a rule, it's not a tough one, just learn it, is you always record stock in the equity section at par, and whatever's above that you list in a cleverly titled account called additional paid-in capital, or paid-in capital in excess of par. So, on 3/1, they issued 6,000 shares at $16 a share. So 6,000 times 16, that's 96,000. Now the par value was 10. So 6,000 times 10 is 60,000. The rest is additional paid-in capital, or paid-in capital in excess of par. So, cash, 96,000. Stock, 60,000. Additional paid-in capital, 36,000. That's not revenue, it's not expense, it's not income. It is cash flow though. It's 96,000, and it's a financing activity. Well, time flies when you're having fun, and here it is, May 2nd. May 2nd, they issued 10,000, they sold 10,000 more shares for $18 a share. So 10,000 times $18, 180,000. It's still $10 par, so it's 10,000 times $10. That's 100,000, or would be if I could count zeros. So that's the selling price. That's par. And the difference The 80,000 is additional paid-in capital. That's hard for you to see. I didn't realize that color was so lousy. 10,000 shares at $18. 180,000. That's the selling price. Then 10,000 at par. That's the par value. We always list that. That's 100,000. That goes in stock. 100,000. And the balance, the 80,000, is additional paid-in capital. And again, that is neither revenue nor expense nor income, but it is 180,000, and that too is a financing activity. So, key takeaway there, you have to remember to separate out the stock at par and the additional paid-in capital. That's the only accounting have to remember. Okay? So, record the transactions in a horizontal statement like the one we showed, so we did that. So we're good with that one. Okay. Determine the amount that S&J Iron would report for common stock on their balance sheet at the end of that year. Well, I think you can see this, but I want to make sure I don't say anything stupid. Something I'm very capable of doing. I don't want to be too obvious here, but if you were to add those together, I think you would get a number that we're going to see is real common. Common stock, we sold 6,000 shares at $10 par. 60,000. We sold 10,000 shares at $10 par. And par is just a legal term. It means the least amount of capital, least amount of stuff the company can have. It really is a totally irrelevant term. It never meant much. It means even less now than it used to mean. So 10,000 times $10, 100,000, 160,000 is our common stock. That's what we would list in the balance sheet as our common stock. And again, not to put too fine a point on it, if you were to add these two together, that's what you would list in your balance sheet as additional paid-in capital. So we have 6,000 shares times 16 minus 10, and 10,000 shares at 18 minus 10. So that's 6,000 times 6, 36,000. 10,000 times 8, that's 80,000. So the additional paid-in capital, 116,000. 116,000. So we did that. Oh, okay, we did B and C. And then it says, what is the total amount of contributed capital? Well, I'm sure you can pretty much see that by now without even thinking. But just to make sure, I'm going to go through it with you. So they have the common stock of 160, that was paid in. The additional paid in capital in excess of par, 116, that was paid in. You add those together, you come up with 276,000. That's the total paid in capital. So we have common stock paid in 160,000, paid in capital in excess of par 116,000, total paid in capital 276,000. And the last thing, it says, what is the total assets they would report? Well, they only talked about one asset, cash. So we're assuming they sold the stock and just kept the money, just sat there with the money in their pocket. They didn't tell us anything else. So they only have one asset, and that's cash, 276,000. Not that having cash is a bad thing, but it's kind of odd that a company would sell stock, raise capital, and then not use it to do anything with.